And perhaps, if you're meeting with officials from CRISP and so forth, you might want to meet with the people from Ibbotson because it's their model, not mine. But they look at earnings forecasts and they try to look at free cash flow for the industry that they're examining, and they drive this off of current financial estimates and analyst estimates for reasonable future forecasts of these financial variables, and then they discount this back to the present and equate it to the current market capitalization of the corporation, and that's how they iteratively solve for a cost of equity capital to equate those two variables.
Just to follow up on that, is it fair to say that one of the underlying premises behind the argument to take into consideration a three-stage DCF with a look at the cash flow is that most reasonable investors would not only be interested just in stock prices but also in cash flows? If you're talking about investing in a business, you might be just as interested in cash on hand, for example, as you might be in stock price?
Well, I think that points to the deficiency in the Crowley-FAP model. They just looked at dividends, and investors also are seeking price appreciation. And over time, if, as Professor Myers explained earlier, if the dividend payout increases because capital expenditures are decreasing as you get way out in time, then investors would get the positive effect of stock buybacks in the future. And what the Crowley-FAP model does is keep the dividend payout at a very low level forever. And that's a fundamental problem. It comes out with cost of equity estimates that are extremely low for that reason. And conversely, the Ibbotson approach does just as you're suggesting. It looks at all of the flows that might be available for shareholders.
And could you elaborate on the Morningstar Ibbotson approach? What is the actual three-stage DCF formula that they use?
Yes, it's actually identical to a formula that's in a footnote that the board put out on evaluating these different models. The first 5 years is based upon IBIS earnings estimates, earnings forecasts. The years 6 through 10 are an average, industry average, or a median of the forecasts of growth. In year 11, they revert to a long-term rate of growth of the economy, GNP growth rate.
Okay. Let me ask Professor Hodder, what's the right beta number? I'll make sure. I'll ask the same question of each four of you.
What is the right beta number?
Right. If we were to adjourn later today and huddle and quickly unanimously agree on what to do next, what's the number? And I'll let each witness suggest that to us.
Well, I guess I would look at, I don't know if we've got it here. What did you, see if I can do a visual average. Well, let's see.
And if, in the interest of time, if you want to do an average, or a range, I mean, that's
yeah, it looks to me like you're probably between about 0.8 and 0.9 currently. Well, I'm eyeballing it here. We've got BNSF is looks like about 0.86. CSX looks like it's something like, it looks about the same. Norfolk Southern's a little bit higher, and UP looks like it's more around about 0.7. And weighted those up, and the number was 0.81.
0.81. Okay. Mr. Crowley, can I assume you agree with that, or do you want to take it?
That would be the same. I would agree with that number. That's the levered beta for the industry, 0.81.
Professor Myers?
Or I would look at my figure 1 for weekly returns, because I think those are the most accurate ones. Sorry.
Oh, sorry.
I would look at the weekly returns figure 1, because I think those are the most accurate estimates, and that plot shows a good deal of stability over time, but I believe a clear upward trend recently. If you just ask me a number off the top of my head, I would say at least 0.8 for 2006 and creeping up towards 1 for what we know in 2007. I'm not proposing, by the way, to use three-year weekly betas, but I do have a picture as a check. I don't know whether we can get that. The 3-year? The weekly returns, if you do 3 years, are going up very fast. Now, I'm not proposing that you just hang your hat on 3 years of weekly data, but that tells you that something's happening recently that seems to be indicating that seems to be pulling the beta up. So, can I just say one more thing? The right way to do this, I believe, from a statistical point of view, is to form a portfolio of the stocks of the 4 major railroads, calculate the rates of return on the portfolio, and then estimate the beta. And that's what I've done in these pictures. The advantage of doing it that way is that first you're averaging across the 4 stocks and getting some of the noise because the portfolio is less volatile than any individual stock. And second, you know what the statistical standard error is because you estimate it right off of the portfolio returns. That would be my suggestion of doing the calculation. If you were going to check this against outside sources, I've been asking around to colleagues that do cost of capital work, and they always refer to Value Line. Value Line seems to be a very widely used source if you wanted to check outside. And in my experience, Value Line has been very big at smoothing over some of the anomalies that occasionally afflict betas.
Okay. Mr. Crowley, do you have any problem with going back to 1926? And what's your awareness or knowledge of what makes 1926 a significant year from a data integrity and record-keeping perspective?
I think 1926 was chosen because that was the first year of Ibsen published the data. I don't think there's any more significance to it than that. I don't think it's necessary to go back that far. I think the 50 years the board has proposed is fine. It's an ample time period to make these calculations, and I would support that period.
Anything particularly unreasonable about 1926?
I really haven't looked at it from a standpoint of unreasonableness, but everybody knows that between 26 and the middle 30s, we had a fair amount of chaos in our economy. And obviously, over the last 50 years, that chaos wouldn't be measured. But other than that, nothing comes to mind.
Mr. Myers?
The reason they started in 1926 is that's when the good data started. The first good data on stock market returns was constructed by the Center to Research and Security Prices at the University of Chicago. It was done not by Ibsen, but it's the same database that the board used previously. That is the standard research database. They started it in 1926 because that was the first year they could get good data for. Ibsen and actually earlier Ibsen and Sinkfeld came along later, and naturally they used those data. But the 1926 is when the good data started. That's why 1926 is always the starting point, or often the starting point for many of these averages. Later, Dimson, Marsh, and Staunton at the London Business School constructed these data series that are pretty good, that go back to 2000 for the U.S. and a dozen other countries.
Is anyone on the panel aware of any past problems with any of the, I'll call the major, highly reputable gatherers of this data, like the Center, sometimes referred to as CRISP, at University of Chicago? In other words, have there been instances of significant error or anything? And my understanding is they just go back and do the sort of the sophisticated record keeping and calculation as to what was trading at what for each everything on the exchange, and it sort of is what it is. It's and if we were to use that frankly that has a lot more appeal to me to use something like that than to hire a team of eager STB employees to go out and comb libraries and do their best at finding the number, and then that just creates the challenge of what prevents reasonable stakeholders from taking a look at that data, whether it's I think it costs about $2,000 right now to access. You know, is that anyway? Is anyone aware of any problems on that?
I'm old enough to remember when it was created. In the early years, the people at CRISP, University of Chicago, put an enormous effort of trying to get the errors out of the data, and it's widely accepted that they've done an excellent job. So it's an excellent database, and it's universally used for research purposes. For your purposes, what you really need is market returns and returns on bonds or treasury bills, whatever, going back to however far you decide to go back. For that purpose, you can buy the Ibbotson books, and the data is all there in tables. So you spend a half hour typing it in, you're done. And it's entirely consistent with the CRISP data.
Does anybody else have any experience on that they'd like to offer up?
Well, I would concur with what Professor Meyer said. I mean, I think that this is a very reliable database. One of the problems you get into when you go to the markets is sometimes you get things that were mistyped, and they spent a lot of effort cleaning that up. I believe that Ibbotson is just running with the CRISP data essentially, and it doesn't change. I mean, you get additions to it, but once you've got it in your hard drive, it's the 1958 number doesn't change. So you put it in once and you've got it. I do think there's an issue, and I would heartily concur with what he suggested earlier, that you can just use the S&P. It's publicly available, and you don't have to worry about proprietary issues.
Thank you. Professor Hodder, on the beta, should we use levered or unlevered betas, and why?
Well, ultimately, you're going to wind up with levered betas. And, if you want to average them directly, I think that's perfectly fine. I would actually also endorse what Stu suggested about estimating this with the portfolio of the four firms. I mean, that way you do get the standard errors exactly as he was suggesting, and you ultimately don't have to wind up averaging. Now, when you go out there and you measure that, you're going to get back a levered beta. And that's going to be, impounding, if you will, sort of the weighted average of the industry capital structure, and I think, that's a perfectly reasonable thing to do.
Would anyone else like to address that point?
Strictly speaking, it should be the average industry capital structure over the period you're estimating the beta for.
Vice Chairman Buttry, any further questions for this panel? Commissioner Moley?
I have a few, but in the interest of time, can we submit some of these for the submit them to respond afterwards? Keep the record open? Well, then no more further questions at this point. Thank you.
Thanks very much.
Thank you. We'll now call up the next panel, a fairly large group of railroad executives. Please welcome. Welcome to our next panel, panel 3, representing the freight railroad industry. We're honored to have a distinguished group of panelists, and we will start with Mr. James R. Young from the Union Pacific Railroad Company. Welcome, Mr. Young.
Good morning. Chairman Nottingham, Vice Chairman Buttry, Commissioner Mulvey. I'm Jim Young, Chairman of Union Pacific Corporation. I appreciate the opportunity to testify before the board in this proceeding, which is critically important to my company and to the nation's transportation system. I recognize that you are facing difficult issues and that you are working hard to reach a result that is fair to all parties. The issues you are facing are difficult because this proceeding is much more than a theoretical calculation. You have already heard from the technical experts, and I'm not going to address those points. I'm here to explain why all of this matters from a real-world perspective, to explain as CEO of Union Pacific how it will affect my company and our customers. One of the most important things I do as CEO is make critical decisions about long-term capital investment to address the service needs of our customers and the returns required by our investors. Capital investment decisions are particularly challenging in the rail industry. As the only transportation industry or mode that pays for its own infrastructure, the rail industry must generate sufficient returns on investment to build new capacity while maintaining and then replacing existing infrastructure as it approaches the end of its useful life. Just maintaining and replacing existing infrastructure is a daunting challenge. Each year, railroads must pay today's prices to replace billions of dollars of track, equipment, and structures that were constructed many decades ago. As our earnings improve, we're close to the point where returns are sufficient to sustain our existing networks. Our capital investment to sustain and expand our network this year will total $3.1 billion. It's the largest amount in the history of Union Pacific. Our board and shareholders have allowed us to pursue this course because they believe our returns will continue to improve to justify these high levels of investment. However, your proposal, if adopted, would undermine the expectations that have fueled this investment. When shareholders talk to me, the message is loud and clear. They tell me that your estimated cost of equity does not adequately reflect the risk of investing in the rail industry. These risks include legislative and regulatory risk, as well as the risk of catastrophic losses and the economic uncertainties inherent in our business. I'll give you a couple examples. 2 years ago, railroads were criticized for not having enough center beam flat cars to haul lumber for the construction business. Today, Union Pacific has nearly 4,000 center beam flat cars in storage. This represents a significant investment that is generating no revenue. There's another example. Capital expansion is more costly and carries more risk today than it did yesterday. We need to build a new manifest yard in Red Rock, Arizona to serve the growing Phoenix market. Local resistance to the project and the demands for mitigation are driving the cost up and delaying the benefits of work already done. Our experience in Red Rock is typical of many capacity expansion projects. Our shareholders view our current returns as too low, and this prospect of unrealistic limits on future returns would reduce the amount of investment they are willing to fund. Without the prospect of considering higher returns as we go forward today, they would choose to put their money where they can earn more at less risk. The proposed railroad cost of equity of 8.4% is less than the returns available in lower risk mutual funds. This will result in less investment, which means the rail network would be less than what our customers want and our nation needs.